All right, welcome back to another video. My name is Ian Major. I'm an entrepreneur, investor, and all-around raging capitalist. And in today's video, we're going to go into inflation. If you haven't watched my last videos, be sure to go check them out. I'll put the links in the description down below. But the last two that I've done were focused on, one, the historical context behind the monetary system in which we now find ourselves. And the very last one I did was around Bitcoin. And is it too late to buy Bitcoin? So be sure to check those two out. And I think, interestingly enough, those themes really come together in this one as we explore the real nature of inflation, which is something that's tossed around all the time. But I think its real implications are not very well understood. And so I'm going to go a little bit into, well, what is inflation? What are its implications, and what's its true nature, and why are we being told that it's a good thing, at least in small amounts, right? And we'll conclude with what you can do about it in terms of protecting your wealth. So without further ado, let's jump right in. In terms of what is inflation, inflation is a monetary phenomenon where goods and services are becoming more expensive in terms of their price level relative to a certain currency. And another way to think about it is your purchasing power going down. So my $1 US today that buys me a coffee, obviously that's not even true today. I'm picking an example from decades and decades ago, but that same dollar is going to buy me less than one coffee in the future. Right, and Investopedia has their own definition here. It's a quantitative estimate of the rate at which the decline in purchasing power occurs. Can be reflected in the increase of an average price level of a basket of goods, and this is indeed how a lot of governments measure inflation, whether it's CPI, in the U.S., other measures elsewhere. It's kind of typically looking at this indicative basket of goods, quote unquote, and measuring the price level of that basket of goods over time. Now, I'm not going to get into in this video the nuances of why these different measures are actually, kind of engineered by governments to systematically underread true inflation. That'll be for a different video. But suffice it to say, there's so many different ways that you can kind of stack the cards in terms of how you create these measures to show something lower than what it actually is in practice. And I'm going to show you some graphs and charts today that hopefully bring that to life. Fine. Inflation itself is not necessarily and always a bad thing, right? If we think about a commodity, for example, oil or really any, good or service, if it's the case that price is increasing due to a significant surge in demand, the price level would increase and we could call that inflation, right? And there's nothing inherently bad in that. What is bad is if inflation is systematically built into the very monetary system itself. And that is indeed what we have with a fiat money system. And so again, if you haven't checked it out, check out my video that I've linked in the description for the historical context of how we got to the system that we have today, which is a total fiat system backed by absolutely nothing other than the trust that individuals have in this, paper money, right? And so that's where it gets nefarious. And, if we look at just a quick orientation on where things stand, it's truly daunting. So when we look at the consumer price index, this is built all the way back to 1775, comes right from the Bureau of Labor Statistics and other historical studies. You can see, it's just absolutely unbelievable. You have these massive wars, Revolutionary War, War of 1812, Civil War, World War I, etc. And these are but blips in the chart. And when we, as we kind of come from 1913, which, as you'll recall, was when the Federal Reserve was created in the U.S., we start to accelerate and ratchet up that growth. And then in 1971, i.e. when we completely delinked the dollar from being able to be exchanged for gold, it really, really takes off. And that is by no surprise. Another way to look at this is in terms of purchasing power. And again, this goes back even further to 1635. We should probably put a little bit of a caveat on some of those early data points. But suffice it to say, you can clearly see the trend here. And it's really been one kind of direction since the 1700s, and that is straight down. And so you say, okay, well, fine, if it's the case that just everything is being priced higher, is it really that bad, right? And what you're really asking is, if my wage or if my income is increasing at the same rate of inflation, isn't it just, we're just kind of pricing things with more zeros at the end? And while that's true in theory, that's not actually what happens in practice. So let's go into what actually is inflation and why have you been told that it's a good thing, at least a little bit of it. So inflation really has been sold to the broader population that, we need this kind of little bit of inflation, right? And in the US, the target is 2%. We need this kind of magic level of 2% inflation, just a little bit, just enough. And the argument is that, well, this helps with economic growth. This helps with wage growth in particular. Don't you want your wages to go up, right? And it's kind of ironic that you would need inflation for your wages to go up when my wages, would need to go up to make up for the inflation. But this is an odd claim, right? Because if we look at the following chart, which shows the actual kind of, this is a 10-year average inflation rate since 1800. So this zooms in a little bit to that first graph we were looking at. We can see that leading up to, really the first or the kind of second half of the 1900s, you have these swings, right? And they're pretty big swings, but they're relatively centered about zero. And so, in fact, the reason for these swings are periods of time, typically wars, where you have, money being delinked from whatever kind of precious metal was being used to back that money. So you'd basically have a war happens, you detach the money from being backed by anything, inflation goes up, and then you get deflation after when you relink the two. And so some of these fluctuations can be explained by that. But then it's quite notable to see that as of really World War II and afterwards, we haven't had a significant period of deflation at all. And what's striking, back to that claim that, well, inflation is this good thing, we need a little bit of it, it just kind of falls on its face when you consider the fact that in the late 1800s, when kind of post-Civil War, so you can see this massive deflationary spike. This was actually simultaneously a period of enormous wage growth. And so think about it this way. In an inflationary environment, the money in your bank account is losing its purchasing power day by day by day by day, right? The money in your bank account can buy fewer goods and services in the future than it can today. And you're certainly not making up for that with interest, right? Because interest rates have been plunged down really since that 1971 kind of key date. We've been in this massive cycle. And so, you're telling me that during a great period of deflation in the late 1800s, you have this massive wage growth. And what's really happening there is people's money is becoming more valuable over time. So they can buy more goods and services with their money over time. And that actually leads to them being able to work fewer hours, right? And so if they're working fewer hours, there's less labor being supplied to the market. And if there's less labor being supplied to the market, then the price of labor is going to have an upward pressure. Wages are being pushed up. And so this whole narrative that we've been told is not, well backed by data. Now, taking a step back, a lot of folks will say, well, where is the inflation, right? If we look at the CPI measure, and I talked about that a little bit earlier of how it's not a very accurate measure. But, you're never going to hear in the mainstream media that, oh, there's inflation, right? We haven't even been able to get up to that 2% level. When in reality, I think, kind of everyday Joe and Jane, is able to see that there is inflation. It just depends on where you look. If you look at the government's definition of inflation, it's not going to show up there. But if you look at kind of everything else around you, you'll see it. So let's walk through a few examples of that. And what I'm now going to turn to are a couple of excellent graphs from WTFhappened1971.com. I'm going to link that below. Have to check it out. I mentioned this in one of my earlier videos as well, but it's absolutely terrific. So, right, what about housing? We all know that housing has gotten more expensive, and you can see a terrific view here looking at New York and Boston specifically, where the median house prices, so the blue and yellow lines, are increasing at a far faster rate than the median household incomes, which are marked in red and sort of gray here at the bottom. So there's this massive divergence right after 1971. And again, it's because you have this massive long-term cycle of ever decreasing interest rates, which are going to increase risk assets such as real estate, and that's increasing at a far faster rate than income. Another way to look at that, this next one is just really, really striking. This is just looking at overall productivity and then compensation in terms of wages and benefits. And so you've got the two in lockstep, which makes sense leading up to 1971, 1972, and then boom, you've got this kind of massive divergence. So this should be extremely alarming, right? This tells you on its face that an inflationary environment, an environment where you don't have sound money, is not good for wages. The other component we often look at is healthcare, right? And so why is healthcare so darn expensive? Well, I can tell you why. Let's look at this chart, which is truly, truly striking. It goes back to 1970 and goes through 2009 in this particular view. But what we're seeing is the growth of physicians, so number of physicians at this kind of modest growth rate, probably pretty in line with the rate of population growth, which you would kind of expect. But then starting in 1971, you see this absolute explosion of administrators. So these are all the kind of support functions that go into, insurance and regulations and regulating the regulators and those regulators regulating the regulators who are regulating right? It's just this massive, massive explosion because the government can get away with it, right? So this whole apparatus attached to healthcare has truly exploded. And you can see that commensurate rise in the sort of spending of healthcare on a per capita basis. Another way to view that and what's happening here is the number of pages in the Federal Register. Again, all of these views are just shockingly, you just have these shocking step changes right at 1971. And this, again, captures the government's ability to dramatically outspend beyond its means, right? When there's the money system is backed by nothing. And we can see kind of inflation showing up in various points. I mean, please do take a look through the WTF happened in 1971, because it's just shocking. I mean, are all of these factors that they're going through causally related? Maybe, maybe not. There's certainly a lot of cross correlations across these graphs, but the fact remains that, something big happened. And you can see this in things like the incarceration rate of inmates. So we're looking at the overall incarceration rate, and then males and females split out. And you can, again, 1971, all before that, relatively stable, right? Relatively stable incarceration rates. And then boom, you see this meteoric rise. And again, it comes back to a government being able to spend beyond its means. Does this mean that, violent crime went up significantly just in everyday life? No. And in fact, we can see just the opposite when you look at crime statistics. They've generally come down significantly over time. And so this, again, is just yet another warning bell, an example of the world we now find ourselves in. Ultimately, the way to think about inflation is twofold. Number one, it's a tax on your wealth. So it's even more nefarious than explicit taxes, because at least with explicit taxes, you know what it's going to be, or at least you know what it's going to be, within a certain time shot. And you're paying that kind of once a year, right? With inflation, you're paying what is essentially a tax on your wealth year after year after year after year. And so the compounded effects of that over a long period of time, can be far more than the explicit tax that, you pay on a year-to-year basis. The other way to think about inflation and what this really is it's time theft. So, a great way to look at this is the following graph, where we see the number of working hours to buy the S&P 500. This goes all the way back to 1860, all the way through 2020. And you can see that the stable, average is about 30 working hours, right? And then all of a sudden, we've seen, particularly quite recently, an upswing dramatically far in excess above the long-term historical average. And so that's the kind of nefarious nature of inflation. It really is this tax on your wealth year after year after year, and it's time theft, right? And this is why people, you look in some of the societal unrest that we're seeing, not just in the US, but around the world, it just seems like things are escalating, right? And why do you think that is? It's because people feel like they're not just unable to get ahead, but they're actually falling behind. And the reason they're falling behind is because you have all these different pieces of everyday life that are becoming more expensive and are completely outstripping any sort of income growth. It should also kind of worry us that, the government goes so out of its way to tell us this narrative. In fact, jumping into the St. Louis Fed, you can see some of their, I'll again put this link in the description, you can see some of what they're writing about this. First, they do at least acknowledge, let's give them credit for this. First, there appear to be at least two different eras characterizing the behavior of prices. Their precise boundaries are hard to establish, but the first era seems to have lasted from the founding of the U.S. until around the establishment of the Federal Reserve, or perhaps as late as the entry in World War I. Fancy that, right? We can later find that they're saying, although average annual inflation since 1941 is higher, it is not dramatically higher than in pre-Fed period. And the two numbers they're comparing there are 0.4% in the pre-Fed period versus 3.5%. And they're calling that not dramatically higher. Do you know how much a 3 full percentage point difference is compounded over time? It's absolutely massive. And then they say, in contrast, volatility decreased tremendously. Arguably then, quote, the costs were small while the gains large. This is from, I believe it's a 2017 paper from the St. Louis Fed. And that in combination with the graphs we just viewed should give you kind of everything you need to know. And so to put a final punctuation on this, we have to ask, well, why is this? Why are they going out of their way to tell this narrative? And it's for a very simple reason. Nothing that I've shown you today is by accident. It's all planned, right? And I think that's the real nefariousness of this. So let's ask, who benefits the most from inflation? The answer is debtors. Debtors can pay their debts back in cheaper currency units. And it just so happens that governments are the biggest debtors of all, with the U.S. being at the very top of that list. And so that's what's happening. The other ramification is that those who are closest to the monetary spigot, those who are closest to where the money printing is occurring, are going to be able to use and spend those new currency units sooner than others where the money will have to kind of trickle down to. And so that's why, hedge funds, large financial institutions, big banks, these are going to, political insiders, financial insiders, these are going to be the groups and individuals who are benefiting the most from this scheme. And indeed, that's what you see with, huge run-ups in asset prices, stock market at all-time highs, while, the real economy is suffering. And so this divergence of, the haves and the have-nots, right? It's not greedy capitalism that's causing this. It is very much the government and the inflationary fiat monetary system that we have today. So, in closing, what can we do about this? Well, if you watch my last video, you already know, buy Bitcoin. Precious metals, so gold, silver, even gold miners are a good play in this sort of world. And in the next video, I'm going to go through this kind of raging debate currently around: are we going to see inflation? Are we going to see deflation? I'm in the inflation camp for reasons that I'll go through in the next video. But put a small amount of your wealth into Bitcoin, into precious metals like gold and silver. You really, really, really want to be doing this. 5-10% is not unreasonable at all. You could go far beyond that, which is where I am currently. I'm, as Raoul Pal of Real Vision would say, irresponsibly long on Bitcoin. But in that case, I'm going to leave it there for now, guys. Hope you enjoyed this content. If you did, make sure to give it a like, subscribe, leave a comment. Let me know what you'd like to see in the future. And again, in the next video, I'm going to go a little bit more into the current debate around inflation versus deflation as we roll into 2021 and beyond. Until then, I'll see you next time.